Good evening, and hopefully you can hear the rockin' Trans-Siberian Orchestra in the background. That is the the truth behind transparent videos. My name is Daniel Young. I am the owner and founder of Adaptive Perspective and the Adaptive Perspective channel here on YouTube, where I help you make your dreams a reality. I am continuing these stock market closed-end fund videos and explaining how we are accomplishing our dreams. So if you want the full methodology, the whole 12 steps to our financial freedom, then head over to Facebook and check out my page there called Adaptive Perspective, Navigate Your Finances, and I give you the whole setup for free. These videos focus on our self-managed closed-end fund portfolio, which is built on lasting dividends, not the gradual sell-off of home funds. So current methodology is invest at least $1 million into the market. And as you go up and down, your dollar cost averaging your buys. So you're buying when the market's down and when the market's up and getting some kind of mid-range value. And then when you retire, you're selling off about 4% a year, which is not realistic. I mean, if you're living off of 80 grand now, it's not going to suddenly disappear, and you'll be living off 40 grand when you retire. So whatever your current salary is, if that's 80 grand or more, and your portfolio is $1 million, if it's 80 grand, that's 8% a year. With the added inflation, you're losing 12% a year. And if you're also factoring in your spouse, depending on what your spouse makes, and if you're both making 80, so you're now withdrawing about 20% of your portfolio a year, that's not great strategy. So our portfolio is built on lasting dividends instead of that gradual sell-off. So that means the day-to-day, week-to-week pricing fluctuations don't bother me. They don't weigh on me. And that's really different than what most market advisors and most market investors understand. My daughter and I had this conversation yesterday. When the market's up and down, so like if you buy low and sell high, that's amazing, right? But most people live and die by that. Like if you have to sell when the market's low, that's not a great idea, but you're forced to do it. But in our situation, I mean, yeah, we want everything to go up, but sometimes it doesn't. So whether the market's low or high, we get our dividends. So if it's low, it's low, and we still get our dividends. And if it's high and stays high, generally they raise dividends. So whether the market's doing this or that, we still get paid. So we want lasting dividends. And ideally, yes, a gradual increase in value. But the up and down doesn't stress us out. So the components of our strategy are that we play the long game. And there's really no quick money in the market. There is, but play the long game. You get a better outcome. It's no withdrawal. So we're designing our retirement and supplemental retirement to pay through dividends and not the cash outs. Now, part of that is buy and hold. Like there are funds that are earmarked and you'll see it in a minute. So we have funds earmarked at, sell at 20%, long-term hold, which is kind of indefinitely until the market changes, or something else gives, or just lifetime. And then any funds that are sold, we just roll over into something else. We target 9% plus dividends, not that 0.5% crap you get with Apple. We buy in fear, like so the only good thing I found on CNN is their fear and greed index. So when everybody's afraid, that's a good time to buy. And when people are really afraid, that's an even better time to buy. Then you get into the cycle now and it's more greed based. So if you believe the Federal Reserve that inflation is in control, and they're doing a really good job controlling it, which I don't. But if you believe that, and if you believe their current mindset of maybe pausing interest rates, maybe even dropping interest rates, which I think they'll drop rates right before summer, so we get that summer madness again. And then I think they'll drop rates again before the next presidential election because they want to look like they're doing a really good job managing the economy. Which, if you're listening to the Fed, this is what we've heard so far. We printed $4 trillion in a really short amount of time. We had no idea that would devalue the dollar and cause inflation. So in order to combat that, we're now going to raise rates, which is going to raise the cost of everything. Doesn't mean it's going to be worth more. It means it devalues everything's worth, and you're going to pay more for it. We raised rates higher and faster than anybody's done in a memorable lifetime. We've raised rates higher and faster than anybody ever. And last month, October, well, I guess we're in December now, but in October, inflation rose. And in November, they didn't raise rates. Makes no sense. But if they pause rates, the market goes up. I don't know about the housing market overall. The housing market, I hear mixed results on. The housing market, I hear that it's still fire in Houston and it's still not as crazy everywhere else. But I have heard it slowing in other parts of Texas. So the market's still mixed. I think it's mixed based on location. I think if the real estate market really slows, like nationwide, that's kind of our ground zero approach to when the Fed's really going to drop rates. Like if the housing market really slows through January and February, then March and April, somewhere around there, they'll drop rates, maybe a quarter point, and it'll set off a new buying frenzy. Now, there's not a huge difference between 7 and 7.25. I mean, in the grand scheme of things, there's really not. But you have all these people who've been waiting to buy a house. They have no idea when the rates are going to drop again, and they have to move for summer. So when you have to move at summer, 7 is better than 7.25. And maybe it falls to 6.9. That's a lot better than 7.25. I mean, you're going to pay it anyway, but now that's a lot better. But then when we hit the presidential election, I think they drop it more because they want to keep their jobs. They want to keep power. And they can say, hey, look what we've done. We've controlled inflation. Doesn't matter that they caused it, but we controlled inflation and it's better. And we're lowering rates. So the economy's in a really good position. Let us keep our jobs. It's just not helpful overall. So currently, the way the market's responded is we've gone from extreme fear of constantly raising rates to kind of the pause. So then we creeped into that neutral zone, like on the pendulum of things between fear and crazy greed, where we were like here in November, and that meter is finally shifted over into greed. So when everybody's putting money back into the market and they've kind of got the feeding frenzy light in their eyes, you can't just buy anything. So if you're going to buy in fear and buy more when you hit extreme fear, you have to demand a discount in those situations. And they're easy to find because everybody's trying to get out of the market, except for those of us who are buying when everything's really low. But when the value of things goes back up, whether it's an actual value or a perceived value, when the value goes back up, you have to demand a discount. Otherwise, you'll pay way too much. And part of our strategy is to never pay premium. We've come close to break even, but we have never paid premium. So how do we do it? So first things first, this is an unedited video. So who knows what you hear as I film these in my house? Who knows what you hear in the background? Somebody is blaring Christmas music right now, which is awesome. It is the cat's witching hour after they had a later dinner. They'll be around, I'm sure. I am not a financial advisor. I am a financial strategist. So whether that's personal money, portfolio money, passive money, I love strategy and I love helping people figure out how to employ the best strategy for them. I don't speak like the herd. I walk in limited companies. Sometimes I walk alone, and I'm okay with that. So we have a specific strategy that I'm going to review today when we we use when we select closed-end funds. And I've talked about it in the past, and I'm going to talk about it again today. So based on our strategy, where would I park money if I'm buying on Monday? Top three categories: bonds, energy infrastructure, so that'd be oil, utilities, overall energy transfer, and then honestly, anything else. Business development or private equity might be first, real estate investment might be second, banks would be third, but really anything falls in that category of anything else. Now, why is that? So if rates go up, and this is everybody's general perceived value or perceived strategy of what you hear on the market circuit junkies. If rates go down, bond value goes up, or bond cost, but bond value goes up. So when rates go up, bond value goes down. Now, the Fed is looking like they're going to pause rates. So that's not lowered rates, but they're also not raising rates. And they've raised rates so much, so often for the past however many months in a row, that them not raising rates is really like them actually decreasing rates. So bond value will go up. And once they actually drop rates, bond value will go up. But if they drop rates, it's because inflation is supposedly getting better, right? If you believe the data or not, I leave that up to you. But if you believe what they say, and all the market analyst junkies, they all say the same thing. So if rates drop, that means inflation is in a better position. So if rates drop because inflation supposedly dropped, if inflation drops, then everything gets better because our money is no longer being devalued at the extent to which it was. So currently, right now, looking for the best deal, but we're looking long term. So 5 years down the road, 10, 20, 30 years down the road, we're buying the best we can right now for where we think the market's going in the future. So based on what the Fed's doing, based on the market overall, based on general strategy, bonds, energy infrastructure, and anything else. Now, anything else has an order. I mean, so business development, because if rates get better, then business development ought to get better. If rates get better, then real estate ought to get better. If rates get better, then more bank profit. Well, banks should profit more, right? So really anything will get better. So let's see where the bargains are this week. Let's see how that looks like. And I'll kind of explain my conversation with my daughter. So this is the closed-end fund master. It gets updated. Every fund gets updated monthly, and every tracking fund, so targeted fund would be a single asterisk, double asterisk, or triple asterisk. All of those get updated weekly. And what they mean. So one asterisk is we're tracking for any number of reasons. Two asterisks are those funds will be coded in blue. Those are the funds we own. So it's a dollar cost average alert just based on our overall average of what we've bought for the fund. Meaning this is, so we self-manage this portfolio. This is everything we own, every purchase we've made, dated amount. I mean, yeah, you see what's here. So like average, the cost to share, how much we bought, what it was worth, what the dividend is, what the dividend pays a period, the annual dividend of that one line item by the yield as we go across, the net asset value, so what it's really worth, what the discount is, the dividends so far since purchase, overall return of investment based on dividend, the ROI overall based on price, and then the combined. So the RO, so these numbers are added together to get that. And then every fund has the overall average price at the top. So every fund in gray we sold, And I am transparent on what we sold it for. So what we sell it for, what the date, and if we make a profit or not. Um, that one didn't get sold. KYN and KMF merged. So that was fun to figure out. This one liquidated. It sold itself. We didn't sell it. Um, excuse me. Dividends. So the projected are wonderful. It reconnected. Wonderful. I have no idea when it stopped and when it continued. Wonderful. Let's try this again. So if this just picks up, that's okay because I haven't explained the system yet. But you have our histories of dividends. So running total when we started last year, this year. But if you come back to the master, this is all funds. And we want to look at the ones that are in discount. Now, the ones in gray are blurred out for either because they're annual or because we have a history with the fund and have don't like how they run the fund. Or they are more than our parameters. So they have a yield under our parameters or they have a cost over our parameters. So my daughter asked, we were talking about our system, and she asked, so you target any fund that has a 9% greater dividend or not? And that's kind of right, but that's not everything. So remember, the yield is just the sum of your annual dividends divided by whatever share price you pay for it. So this top one, so it pays you quarterly. So that would be 4 times a year divided by the cost you pay for it, right? Move the decimal place over 2 or multiply by 100. It's 8.77, right? So we are targeting 9% or more dividends, but that's not everything. We want a discount. Well, besides the 2 lines at the top, we come all the way down. Where are we? That's the last one in discount. So there's 373 funds currently selling for less than what they're worth. So you have to put in a ton of effort, or you let me put in the effort for you. You filter out funds based upon the historical value of the fund. So the 3 asterisks have current discounts that are double the historical discount and are greater than the 5-year discounts. So you get it at the best possible discount. And it's kind of the way this got originally explained to me. It's every fund, every management team controls their fund for whatever reason, right? But once you hit double your historical discount, your shareholders tend to go, wait. Like, we all like a great deal, but we need some changes. Like, we don't like this great of a deal. And whether that's true or not, I don't know. But at the same time, we all like a discount. Like, if I gave you the option, would you rather pay $1 for something, or would you like the same item 10% off? 90 cents or $1? We'd all like 90 cents. But how do you know if the 90 cents is the best deal you could get for the same item? Like, Amazon's got a tracker on it where it'll show you the best price in the last 30 days. So maybe today you're buying it for $35, but 3 days ago it was $30. Well, 35 is better than the full price, but you would have liked to have gotten the better discount. And that's kind of what we're doing. We're optimizing the discount. So that we're ensuring we get the best possible deal. So when we screen these, mean, I recently updated every fund on here. There's lots of funds selling for discounts. So we put in some parameters. So a yield less than 6 or cost over $16. We don't want it. Unless some, like one of the people we read, they recommend the fund for whatever reason. Then it gets highlighted in purple of just interesting. And it gets earmarked. Now, currently selling at 20% off or 19% off, I guess you could say. So if that fund, if we correlate percentage to dollar, so if break even is $1, then 19 cents off, you'd be paying 81 cents. Now, 81 cents instead of $1 is great. But in the history of the fund, the historical discount sits around 10%. So 19 is close to double minus 10, right? That's close to negative 20, but it's not. Now it is above the 5-year discount, but so it doesn't meet our parameters versus this fund currently at 32% off, right? So instead of paying $1, that's 68 cents. So at 32%, the historical discount is near 15%. So we are double the historical. And the 5-year discount sits at 22%, and we're greater than that. So that one gets the earmark. So in looking at all of these companies, now, not everything is highlighted. I mean, I'll be honest, the vast majority have notes. When we look at the asterisks, we have some single asterisks that we track, but they're premium. So they don't make the cut. There are funds we own that will shift into premium. We track them, right? But they're not on the buy alert list. This fund is in discount, and we own it. But it's a dividend reinvestment. And I've learned that for our investment strategy, that's not ideal for us. Dividend reinvestment is, let's say, because this works, let's say you own 100 shares. So every quarter, they pay you $16 for owning the fund. But it's money that never actually lands in your hand. So $16 would get deposited into my account. They'd say, thank you for owning the fund. And then right after that, they take the $16 back and they buy more shares of the fund. So I end up with like 104.6. So in the grand scheme of things, it actually lowers my overall buy-in value, which means I get a greater return when I sell it. But I never actually get the dividend cash in hand because $16 doesn't seem like a lot, but I would much rather have $16 in my hand that I can then go buy something else I want because maybe I don't want more of that right now. Or maybe I need to take the $16 plus $400 out for a month, but I never get to actually receive the $16 and keep it. So this fund, even though it's an amazing fund, comes amazingly recommended. It's earmarked for sale because we never actually get to keep our dividend. Coming up. So almost all of them have earmarks. Some of the ones, I mean, we're tracking these based on recommendations, so I just skip the earmark. But when we get up here, these are the ones that make the cut. Current just means we currently own it. So all of these are discounted. All of them are significant based upon the company's own data. That way we're comparing this company to itself, not necessarily to something else. Meaning, so it's -5. Like, so instead of paying $1, you're buying it for 95 cents, right? So it hadn't been around that long. 3-year discount is almost 1.6. It's a municipal bond fund, so you actually get an added perk of owning it. But 1.6 times 2, right, would be 3.6, and it's currently less than that, so that's still a good buy. But for us, we really don't want to buy anything different than what we have. But before I even get there, so all of these are significantly discounted. Okay, so then we could come to yield and rank that. So we want to target everything that's 9% and above. If you wanted to target based on when it pays you. So my daughter and I were talking about this. When would you rather get paid? I would rather get paid monthly unless a quarterly fund will outpay what I earn monthly. Meaning this, I like this fund. Okay, it pays you. I mean, I do. I like this fund. We own a good amount of it. And we own, so my push has been to hit 200 and everything. Actually, that one, let's see. Let me rephrase. My push has been to hit 200 and everything we're keeping long term. HQL is a off number because it's got that drip allotment. So if we compare this fund, right, that's what you get every quarter, to this fund, $0.21 looks like it would be greater than this, but it's not, because you get this other fund paid monthly. So 0.077 times 3 is actually more than what you would get paid per quarter. I like this fund, private equity fund, right? But you're only getting 8 cents a quarter compared to this per quarter with that fund. So it's kind of interesting how it all lines up. So if we sift down based on discount and we identify our targets, and then we sift out or target our yield range, then it comes down to overall cost, comes down to when it pays, and it comes down to your overall strategy. So this fund, I mean, it's recommended, but it's kind of close to our cutoff. I'm not interested. Would these funds give us more than what we would get through what we currently, would they improve anything that we don't already have? Now, diversification just for diversification, waste your money. That's Warren Buffett's thing. Like, if you're diversifying, that's like scraping butter over too much bread. That's diluting your ability to invest where you need to. That's the other added value of closed-end funds. It's like a mutual fund, but you get a much better dividend. So all of these funds, like this is a technology fund. They invest in all these other technology funds that have all these different dividend cycles, that have all these different values. Like, for these funds, that's a buku of money just to invest in one share of those funds. And at least half of them don't pay you a great dividend or a dividend, right? But we can get access to those funds for less than $5 a share and get a 10% dividend. Like, that's great. So you have technology, business development, energy and infrastructure, healthcare, tech and semiconductors. This is bonds and communication, or sorry, that's mostly bonds. That's bonds, real estate, energy, communications. These are heavy preferable and convertible, or heavy convertible shares, some preferred shares, but heavy on the banking end of things. All of us give us great access, but would these give us anything more than what we already have? They're very similar funds, heavy tech, financial, industrial, some consumer. And I don't want a lot of consumer stuff. That's just me. So I line up with this one, but it's heavy tech, and we already have several heavy tech funds and several industrial and financial funds, so it doesn't really add to anything we get. Plus, so if we bought 50 shares of that, I still get a better return based on what we already own. So it doesn't really add. So, like, I like them, I would love them, but it's to the point where we're investing in what we have, and investing somewhere else dilutes our ability or diminishes our ability to invest in what we already have. Now, if they paid a greater dividend, I could argue better for it. But as it stands, as much as I like them, we get a better return if we invest in something we already have. So what would we invest in? So we've looked at discounts, we've identified our targets, we've identified the yield. I always like it this way. You can strategize based on where you want to get paid, but it goes back to where I think the market will go. So with lowering interest rates, right, lowering rates overall, the bond market in general should go up, but the value of everything should go up, right? So all of these things should go up. The tech market, I think, is still overpriced. So that eliminates these two guys. Plus this guy, we're not going to hold on to long term. I like EOD. It looks like it would perform amazingly well, but for whatever reason, their dividend pricing has fluctuated some. Healthcare. There's advantages to owning healthcare. The problem is we're still seeing a lot of bad data. Not bad data in the sense of bad data for the healthcare industry. It's that the healthcare industry has ignored some data and not shared some data. And there are companies coming under fire for what they're making and what they're not making. So we're going to delete that one off. And that leaves us with bonds, banks, energy infrastructure, business development. Our push has been to hit everything at 200 based on the best deals of the time. And then once we hit 200 of the stuff that we're keeping indefinitely, then to circle back around and then retarget things based on how the market's doing. And we've done fairly well with that overall. So that's the easy outlier. But if it weren't the best situation for bonds, like if banks were in a better position long term, or oil and energy, right, or business development, we would target where we thought the market would go, not just where it is. But as it stands, all of these are great investments in the long run. So heavy convertible in banking. Bond fund, really good bond fund, really well-run bond fund. Just not the interesting thing about closed-end funds is most people don't know about them. Warren Buffett invests in the closed-end funds. He loves the dividends. His own fund, Berkshire Hathaway, doesn't pay a dividend because he would rather reinvest the money made back into the fund. So he loves getting dividends from closed-end funds that he reinvests into Berkshire Hathaway. He does not like paying you a dividend because he doesn't want to pay you a dividend. But you can, and I don't remember which one, but you can find Berkshire Hathaway in a closed-end fund. So they own Berkshire Hathaway amongst all this other stuff. So now you get an indirect dividend from Berkshire Hathaway. So of what we would pick, so it goes back to where we think the market will go long term and short term. So bonds, energy infrastructure always. I mean, regardless of what the market's doing, energy infrastructure. So if it's like strategy wise, you could argue for any of these because they're all great discounts in relation to what the individual company's doing, but they're all better than the historical data for the individual companies. So banking, great long term, right? Low pricing right now, they pay a great dividend, the market takes off. They cut these guys cut their dividend early in the year. So if the rates come back, they will increase their dividends. Or if the rates go back down, the market comes back, right? They'll increase their dividends back. These two have kept their dividends, but I want to say HCLB raised their dividend early in the year and kept it this way. After the merger, KYM was supposed to raise their dividend to 22 cents. Now, 1 penny is not a huge deal, but it's still a dividend increase. And scratching noise is my cats chasing each other through the house. And they haven't returned to pre-pandemic dividends. Like pre-pandemic, their dividends up in the 40s, like 40 cents, not like $40, but 40 cents. And then business development, same thing. It's like the housing market. If rates dip overall from the Fed, then just like home loans will come back down and banks will make more money than business development loans will get issued more often and the banks will make more money. So all of them are good things. It just depends on your individual strategy. For us, it's what I said a couple of weeks ago, or really last week. It's either this one or this one. I like things to be in sets of 50. So the push has been to get everything at 200. And this pays a monthly dividend. Rounding that out to 400 would be great, but it's not going to pay another dividend until January. So this price will fluctuate, I think, a little bit more than the bond market, but that's just me. The word out of OPEC is that it makes no sense, but OPEC globally went to, we're going to cut, production, and not everybody followed through. So with overall rates down, this value increased, but we're still seeing oil production higher than regular levels. So the oil market overall and the gas prices overall are going to fluctuate a little more than I think they would normally. That being said, they're still higher than they used to be. I mean, they're lower than locally around Houston, it's under $3, which is great. But at the same time, it used to be $1.80 for gas. And even at $1.80 for gas, I think that number would take off. That's just me. So where would we go for Monday? Well, bonds, energy infrastructure, and everything else, right? In that order, bonds, energy infrastructure, and everything else. So this is bonds, real estate, communications, and energy. And that is all energy transfer, energy infrastructure, utilities. And then as good as I can make a case for all of these things. I really can. I can make a case for all 6 of them because that's bonds, that's a mix of bonds, that's banking, energy infrastructure, business development. But based on our list of strategies, or based on our strategy and our list of targets, bonds, energy infrastructure, everything else, that means these would go away. And since we already have 200 here, this goes away. Now, the other factor for us is that's our existing available balance to invest. So we can't buy more here because it's more than what we have. You could be like, well, you could buy less. Well, that's true. But I hate buying under sets of 50 unless I'm rounding out something we already have. We could buy a lot of this. That's right. Like we could buy, gosh, like maybe not that much. Nope, still not that much. Yeah, we could buy a ton of that, right? So at 300, we're getting $100 back. 300 shares gives us about $100 back. But if I increase this to 200 total, we get a better dividend. And I like this company. Like I like it, and it's it's a different way to look at the loan industry. Like there's real estate loans, business loans, uh, bonds are not loans, but they're similar. It's a great long-term hold, but it's hard to get me to put more money here when we can make money monthly and make more money here. So we already own 200 here and we can't buy a set of 50. We could buy a set of 50, but we wouldn't get another dividend. Well, actually, so it'll pay this month, but then after that, we'd have to wait 3 months. And we could make a lot more money here. And now we're down to 2. And it's the same 2 from last week. Now, if we go back last week, 811, 832, it's gone up in value. So stalled rates, it's gone up in value, right? 844, 864, it's gone up in value. Everything fluctuates. Your buy-in price matters, right? Because it determines your overall dividend for that individual purchase. And it relates to everything else you've bought for that individual purchase. Okay, this is our line of HGLB. 12% might raise it a few points. KYN is almost 10% right now. Last month, nope, 970. It would probably raise our overall yield. But we're not doing it like the yield's important, but we're not doing it just so our existing yield goes up. Like we're trying to get the best deal we can for the money. So I would love to have that at 400 and just let it sit. But we don't get a dividend until January, or we could buy this, get a dividend this month, and get a dividend in January. And yeah, 2 months, right? So we get December, January, 16.8 compared to 21. You still get a better dividend here. But overall, out of curiosity, for the year, I mean, yeah, you get a better dividend here, but it's not monthly. So that's kind of that's the coin, I guess you could say. So the options would be side one, you buy one. So like heads, bonds in a mix, tails, energy infrastructure, or on the offhand, it lands on the edge. You don't buy either. And you don't buy anything, you just let it sit. So that's kind of where we are. So if we're buying Monday, I can argue for both of these. It's a split vote. And my take changes honestly day to day. Like having this be a solid 200 just to circle back around and see where everything else is, see where this is in December, see if the discount is still significant, buy it at that point, because we will, like if we bought this, we'd have $4 left, but we would get the December dividends. Maybe we would have enough for because we'll get end of year special dividends. That's been the history with certain companies. Maybe we would have enough the next round to pick up the 27 shares. Maybe. Um, maybe we would sell those two other funds. Then we'd have plenty to buy 27 shares plus anything else. Or maybe we buy the 27 shares now. It doesn't eat the full amount, right? Now we have a little bit of residual left over, almost $200 left over. And then at the end of the month, we see where this is and see if it's still a great deal. And if we have the money for it, and then we buy it then. Or if there's a better buy-in value at the end of the month, now we have a little bit more padding that we can then buy something else. So, I mean, I can argue for both, but both fit our overall strategy for right now, and both fit our overall strategy for 5, 10, 15, 20 years from now. So I'm going to leave it a split vote for right now. And if we buy something, you'll see it. Uh, generally, when I buy something based on whichever video recommendation, I'll color code it differently, or I'll put it below, but then you'll also end up seeing it on one of these lines because I post everything we buy. I post everything we sell. It's complete transparency because without this, like if I'm just posting one share at a time and one dividend at a time, you don't see the change over time. But what I also wanted to show was this. So we run our portfolio on Webull. Webull tracks overall value. So that money invested, money down, percentage lost. They do not track our dividend amount. And where that dividend amount comes in, we track it on here. So total shares, because I'm curious, total investment, our annual dividends, our overall return, the dividends we've accumulated so far in a little over 2.5 years. So on a dividend scale, we continue to increase dividends every month, regardless of the overall value of our portfolio. So currently, we're 4% up just based on dividends. After another year, the number will go up. The more we invest, right, all of that goes up. Because whether this number's been break even, it's been positive, it's been 18% down. And as much as being 18% down sucks because you're like, man, the market, we still get paid dividends. So the market can be in the dumps and we still get paid dividends. Or it could be soaring. And most everybody changes their dividend policy and you get a better dividend. Right? So what would you rather have? Market your individual portfolio value based on the current day-to-day market, and that's it. Like Apple, you get a 0.5% dividend. I mean, if you believe the Fed actually lowers interest rates to 2%, if you believe them, you're losing 0.5% every year. Or, well, so you're getting a 0.5% dividend at 2% inflation. So you're actually only getting, my brain is not working right now. So negative 2%, you're losing 2.5% a year. 2% for inflation, half percent for Apple. So your Apple investment is getting devalued by inflation, and that, no, that doesn't make sense. If, let me put it this way, it's late. Let me put it this way. If your Apple dividend was 2% and inflation was negative 2%, then you would break even. But your Apple dividend is not that. So you're losing money every year just based on the Apple dividend. So would you rather deal with the day-to-day management of how much your overall portfolio is worth, which is, I mean, like, I get it, it's important data, right? And that this is what it was yesterday when I did the complete closed-end fund. So it's the stalled market, right? Like it's final closing prices on Friday, right? Like if your everything is wrapped up in how well your overall uh, portfolio value is doing day to day, that would be really stressful. That would be really stressful for me because then I'm looking at when I have to take money out again and how much can I take, all of that stuff, right? But if I don't have to worry about this, it's like 8% down, but yeah, it stays. I mean, 18% down, that sucked, but we still got paid dividends. And like right now, we're 4.5% ahead. You know, if the market were 18% down, we'd be 4.5 behind. But the next month, right, our dividends overall would go up. We would still get our dividends paid, and we'd still have the same 18% loss. And then we would get closer and closer to break even and then move past that. So that's why we structure based on dividends, because regardless of what the market's doing, whether it sucks or whether it's amazing, we get paid dividends. And nobody likes to see the market low, but we still get paid dividends. So you can structure your portfolio to retire on dividends, leave the principal intact, never touch it, add to it, but never actually withdraw it. Or you can follow the market advice and put $1 million plus into the market and withdraw. Now, from their standpoint, you're withdrawing 4% every 4% a year, so 40 grand a year, in hopes that the market gains 4% or more a year, so you break even. But that's bad strategy. So you're making 80 grand plus, that's 8% a year. So if it's 8% a year, you're withdrawing at random times. It like based on whatever the market value is at the time. So 8% a year. You're also losing 4% for inflation, that's 12%. And if it's for you and your spouse, there's another 8% wrapped in there. Right? So you're actually losing 20% a year, hoping the market gains 4% a year. So you're actually down 16% a year. That's not sustainable. And that's from my standpoint, that's why we're seeing people retire. And then a couple years go by and they're like, crap, I don't have enough money. Now they're back in the workforce. And they're working because the retirement they took the advice from all these experts on doesn't actually work. Think of it. Oh, gosh, $1 million divided by $160,000. You have enough money for 6 years of retirement. It was supposed to last you 25 years. You have enough money for 6 years of retirement. But in our situation, $1 million invested at a 9% yield, now you're making $90,000 a year. Was it 160,000? No. But instead of you withdrawing your $80,000 a year, now your account is paying you $90,000 a year and your $1 million is staying intact. Right. So it's a completely different strategy. Completely different strategy. Gosh, a completely different strategy. So that is all I have. My 2 picks for the week, just for us and our strategy, that would be HGOB and KYN. If you like the content, consider subscribing to my channel, hit the like button, head over to Facebook and join my group there called Navigate Your Finances. As you face the week, as we get ready to hit the Christmas season, and as we get ready to face another year, you are the captain of your ship, and your ship will go wherever you steer it. So make sure you know where you're going and why. Like, make sure you know your dreams, make sure you know your reason for going. And yeah, you have a lot to learn on the way, right? You've got to figure out what you're hoping to do, how you're going to do it, budget, strategy, all that. right? But if you want to backpack Europe, or if you want to live on a houseboat, or if you're like me and you want to earn, but if you want to, gosh, cats, if you want to buy land and build a hunting ranch, know the reason behind why my cats are distracting. You have your dream, right? But know why you're on this journey and how that all fits together. If you have no idea what I'm talking about, I talk about that on Facebook. So go there and check that out. Just realize that metaphorically, maybe realistically, maybe you do live on a houseboat, but metaphorically, wherever you're headed, you are the captain of that ship, and it will go wherever you steer it. So if you have no idea what you're doing, that ship will continue to turn in circles and not go anywhere. Right. And you can crash that on the rocks, and you can get grounded, and you can do a lot of things, right? But if you know where you're going, you will pilot that ship a lot better and have a lot greater success. Oh, good. I thought it paused on me again. Uh, yeah. So you captain that ship, right? You have immense amount of power to make all these financial decisions. You just have to figure out which ones are the best for you, right? Because there are a lot of different people that will offer to help you, and you have to get really good at figuring out who's trying to help you and who's trying to show you a pretty meme or a pretty strategy that's not going to help you at all, right? So do the work, right? And your dreams, they can happen, they can, but they're not going to happen by themselves. So whatever it is that you want to do, make that happen. And that means you look at strategy, and you look at plans, and you look at your dreams, and you look at all of these things. But if you really do want to accomplish your dreams, you have to do something about it, because they won't happen on their own. There's no way I will manifest a mindset that will make my dreams of owning a hunting ranch go poof. It just happened. Our youngest kitten is a nightmare. He's like, it's like we have a drug addict. It's like he finds LSD around the house, or I don't know what he like. It's not catnip. It's like he hits a hidden batch of methamphetamines and then just goes nuts for a while. Like nuts for a while. Um, but at any rate, it's there's no way for me to just be like, I'm going to think I'm going to own a deer ranch, and poof, it's going to magically happen. It doesn't work, right? So if our existing strategy doesn't make that happen, then we have to reevaluate and find a way to make that happen. And you have you don't have the same dreams, maybe you do, but you have your own dreams. So if all of your strategy is not allowing you to help, or it's not allowing you to get where you want to be, right, then doing the same thing over and over again isn't going to allow you to get to where you want to be. So you got to reevaluate what you want to do. Do you still want to do that stuff? Okay, yes. Is your strategy working? No. Then why do the same things? Don't be afraid to change things up. Don't be afraid to completely revamp your strategy. That's what we did. Scary as all get out. But that's what we did, because if we kept doing the same stuff that's not working, guess what? It's not going to work. So change your strategy, right? Pilot your ship. Be a good captain. Lead your crew. Learn. It's not going to just automatically pop in your head of how everything's going to go. You're going to have to learn along the way, and you're going to get better along the way, right? But have a destination you're going. Otherwise, you're just on a happy joyride with no end in sight, right? You've been on those. You never really go anywhere, except now it's your life. Know where you want to go and go there, right? Like know where you want to go and then make it happen, because you can do it. And if you have no idea what I'm talking about, and it sounds like I'm just talking in a foreign language, or sounds like I'm talking out of my rear end, or that I'm just talking crazy. I kind of like the visual representation of my cat running around the house. But if nothing really makes sense, then go over to Facebook and look at what I'm talking about. Look at my page and then search for dreams, or search for why. Like type it in capital letters, giant WHY. Um, Look at, say, search for step one, okay, or identify your dreams, something along those nature, right? Look at the free files, and then let's talk about how you can identify your dreams, and then let's look at a strategy of how you can get there, whatever that is. If you want to own your own private island, if you want to amass $2 million of wealth in the next 7 years, and you have no idea what you're doing, let's figure out a way for you to do that. Is it possible? Given your situation, yeah. Sounds crazy. Sounds completely against the grain. Is it possible? Yes. Our goal is to leave this house in 5 to 7 years and move to property with the purpose of having a deer ranch. Is it a lofty goal? Is it possible? You have to want it. It won't just happen. You're gonna have to do something about it. Like I could go to my job every day the next 7 years, and my dreams aren't gonna happen. My cats. Your dreams don't happen at work. They happen outside of work. Your work helps those dreams happen. I'll say it again, your dreams do not happen at work. Your job allows you to accomplish your dreams. And pending your job and pending your dreams and your side hustle and all this other stuff, your job might be able to finance your side hustle. Your side hustle will allow you to make your dreams last. Maybe you can leave your job. Maybe you love your job. Maybe you don't. I don't know. Right. But if you keep doing the same stuff, nothing's going to change. And if you're scared about change, I would love to chat with you, because I've been there. And I can tell you change is good. Change is scary, but change is good. But I will, gosh, I can like stand on my soapbox. It's, if you want a different outcome than what you're getting, you have to change the way you respond to things. If you want something and your existing strategy is not directing your course towards accomplishing that dream, then you're not going to accomplish that dream. So if you want a different reality, right? If you want a different strategy to get from where you are to where you want to be, go to Facebook and let's talk. You can comment on the video, but go to Facebook and let's talk. And let's talk strategy, and let's talk you, and let's figure out how I can help you. And I'll be honest, on Facebook, my goal with making a Facebook page, as crazy as it still sounds, was to not charge people money to help you. Like, it still sounds crazy to me. Like, my goal was to give advice and to be a sounding wall and to help you with strategy. And at or at least I'll be honest, at the beginning of things, my goal was not to charge you anything for it. If you want individual one-on-one coaching for X amount of time, we'll talk. But if you want general advice and strategy and somebody to bounce ideas off of and help with figuring out how to get from where you are to where you want to be, the reason I created that page is a general advice page where I don't charge people money, which sounds completely nuts, but that's the truth of it. I find it hard to and I get it, it's a service, right? Like, it's my business and you need help, and most people would say that that's a financial transaction. But if you're struggling, I have a hard time charging you an exorbitant amount of money to get help. Like you're struggling month to month to make ends meet. Gosh, pay me $150 for a 30-minute consultation. $150 when you're struggling to make ends meet is a lot of money. Like $50 when you're struggling to make ends meet is a lot of money. It it doesn't make sense to me to price gouge people who need help. If you want long-term help past that, if you want individual coaching, if you want me to take a more active role in helping you out as you go through the journey, then we'll talk. But for now, honestly, if you want help and a sounding board and advice, then please find me on Facebook and send me a message and let's see how we can help because I want to help you. So, strategy wise, nothing will change. Like if your current methodology, if your current strategy isn't getting where you want to be, guess what? Nothing's going to change. So if you actually want the ability to accomplish your dreams, you're going to have to do something different. And if you have no idea what that looks like, find me on Facebook and let's talk. So stocks wise, that's what I got for the week. HGOB or KYN, and overall bonds, energy infrastructure, and everything else. Just make sure you get a great discount and you don't pay premium. So to reiterate my normal closing, it's you are the captain of your ship. So make sure you're a good captain and make sure you know where you're going. Yeah, pilot your ship well, captain your ship. Yeah. So have a great week. We'll talk to you all later. Bye bye.